Okay, so I think I've been given the go ahead to start. Okay, so every time we meet, uh, I always start with two slides, market cycles, and then how is it that Milestones to Wealth actually takes advantage of these market cycles. Right. So before I get into this, Milestones to Wealth is a behavior-oriented program. It's not a platform that gives you buy and sell recommendations. It's only a behavior-oriented program, which means that uh, we help you understand how things work. We make you understand how things are usually working and how uh, things will work for you based on your particular goals, based on your particular risk profile. Right? It's just a program where our endeavor is that everybody should reach a minimum corpus of 1 crore in financial assets. So it's a program that will help you just to meet your best, right? With whatever goals you have, be it a home goal, be it a retirement goal. But at the end of the day, you should be able to meet your goals by showing the right kind of behavior in saving into assets like uh, mutual funds, be it equity mutual funds, be it debt mutual funds, or be it precious metal mutual funds. Right? So it's completely a behavior-oriented program, right? Where we start off with helping you understand how much you can save, how much you should be saving based on your potential. So create a savings habit, right? And in turn, push you and help you understand how it can lead into an investing habit, right? So saving habit and then investing habit, right? And our endeavor is that yes, every investor who comes onto the platform in their own course of time, right, should be able to save a corpus of 1 crore, right? So which means save, right? It's not grow, it's save a corpus of 1 crore. Ultimately, yes, that would lead to a lot of growth, but it's to save a good amount of corpus that will help you meet your financial goals, right? So now market cycles. This is a slide that I always do in all the presentations because it's so important for everybody to understand how market cycles work. Right. Now, market cycles can be short, market cycles can be long. Right. Some market cycles are 5 years, longer ones are about, you should view them as 20, 25 years or so. But every cycle displays two very similar traits of pessimism and optimism. Right, pessimism that leads into over pessimism, which is people are very scared to participate, and second, uh, optimism that leads into over optimism, where people just want to participate. Right, they don't want to do anything else. They just want to continuously keep buying. Right, one way where we have sell, and the other way where we have buy. Right. Now, why is it important for you to understand this? Is because over optimism creates this sort of dichotomy in terms of what is real and what's not, right? So people start overpaying for things, and everybody starts getting extremely overconfident, and whatever negative starts happening, that again leads into bigger drawdowns, leads into bigger issues, right? So the expectation that starts riding onto optimism and over optimism is very high, right? And that's what we need to sort of avoid. So what do you do in this case, right? When over optimism is there, people start selling. When over pessimism is there, people start selling, and when over optimism is there, people start buying, right? But one important thing is that as a saver, as an investor, you must always be of that mentality to buy, and not sells should not be that much unless and until you've met your goal. Second, where things are extremely heated in that particular asset class. Now, why do I say asset class? Is because market cycles work different in each asset class. Right, there's a different winner and there's a different loser in each of these asset classes. Right, within equity you might have different winners within equity as a category. Within debt you might have different winners uh, over that course of that particular cycle, say 5 years or 6 years or so. Right, so every time there will be a different winner and every time there will be a different loser. So participation is very important in every given market cycle, be it whether it is a fearful market scenario or an extremely greedy market scenario. Right. Participation is always very important. So now, how does Milestones2Wealth actually take advantage of this particular cycle for you to understand how we're wanting to participate, how you should be participating as a saver in India, right? Whenever you get a boring market, always take advantage of it. You should be able to do a mix of lump sums plus SIP plus stepping up your contributions that you do on a monthly basis, right? Whenever you get a bonus, whenever your salary increases, right? You must look to step up your SIP. Now, I had already done one webinar on how step-ups work and how you can reach 1 crore and when you can reach that 1 crore while you're continuing to do your SIPs, right? I think that was on May Day, Labor Day, but it's completely available on YouTube for free. You can just go to Milestones2Wealth on YouTube. You can just go to the live section and then you will find SIP to 1 crore as the topic. There I have covered how you can use SIP and you can use step-up SIP to actually reach that 1 crore corpus that you have in mind, right? But how we usually look at things is to participate. The rate of participation goes up when there's a fearful market, and of course, when the exciting market does come in, you reap the benefits. Now, reaping the benefits doesn't mean that it's a sell, something like that. No, it is, yes, you are able to reap the benefit of it because yes, you were able to participate a lot more when things were not working in everybody's favor, right? So obviously you will benefit out of this. Like I said, sells only come when things are extremely overheated. Is where yes, yeah, you have to take that bold call of yes, I need to move to another asset class. Second is when uh, you are very near to your goal or your goal is getting met. That's when you should actually look to reap the benefits out of it in an exciting market, right? This is what Milestones2Wealth does from a behavior model, right? So, but today's topic is now going to be majorly on the debt side, which is another asset category. Now, we've covered a lot of webinars on equity. We covered one last week on arbitrage, and now again we are going to debt. This is another topic. It's a very similar topic. If you had attended this couple of months back, you might not find this to be very helpful in terms of debt, but yes, you can definitely participate in the Q&A, and you can ask me any sort of questions you want on debt. So now going to debt. Now, why are we taking this sort of a duration call? Now, duration calls means it's a longer term call, right? We are taking more than a 10-year plus horizon on debt as an asset class. Now, there are two reasons of why you should be looking towards duration. One, and whenever you look towards duration, one is more structural, right? So India is we are going through a very good phase in terms of macro scenario, right? Money from outside is coming into bond markets. If you've been reading the newspaper, you would know that yes, we are getting included in the bond indices, and that would ultimately mean $20-25 billion worth of foreign flows coming into the debt market. Now, why it's important, we'll cover it later. But from a structural point of view, our macros are improving, right? Our CAD has come down. Our fiscal deficit again is under control. It's down, but it's very much under control. Given that we are expanding our balance sheets, it's all under control, right? Now, cyclical changes. Now, this is globally, we are seeing high inflation coming in, and this is something that we had discussed a couple of years back also, saying that yes, inflation is going to be a very big problem for the developed nations and all the developing nations, because India has always seen inflation. India has always seen 12%, 14% sort of inflation in the past. Right. So for us, inflation is good. For a developing nation, you need to have inflation. Right. Why you need to have inflation? Because healthy price increase is very good. Right. For developing nations, healthy price increase is very good. Right. So inflation moderating for us is also very good. It's still within that band of 4 to 6%. We are still within that band. So for us, it's a good scenario, right? Global policy rates across the world, they are peaking out. Now, we don't know whether there will be a rate cut or not, but I have an interesting poll ahead. But we don't know. It's expected that this year would see at least one. They are predicting three. A lot of analysts are predicting three, but it's somewhere between 1 and 2 is what they are predicting. And yes, things have peaked out on the policy rates. You're still seeing strong numbers coming in from housing, housing and unemployment. So which means that unemployment is not very high, but they are going through a good expansion phase in the US. Right. So we are seeing that rates have peaked out. So there is a good it's a good tailwind there, and money does come in, which is another plus point for us. Naturally, your rates would come down. There will be a lot more participation that happens on the debt market side, right? And ever since our government has changed the taxation on debt, people have shunned this category and said that no, we should not, participate in this category anymore, which I think is unfair. Right, there is still inherent opportunity that we can make here on the debt side. Right, I already covered one on arbitrage and why arbitrage. You should look at arbitrage only from a liquid fund perspective, and that if you want to park money for 6 months or 8 months or something like that, something like a short-term FD replacement or something, then yes, arbitrage works in a bull market. When does arbitrage work? When arbitrage works in a bull market, it does not work as what it does best in a bull market unless if there is a volatile bull market, right? In a bear market, it does not work, right? So always look at such things from a bull market perspective. Now on the debt side, whenever you have a scenario where things have peaked out and structurally things are looking good, then yes, you should look towards longer term duration debt calls. You definitely must look at longer term debt. And if you look at our core inflation, right, our core inflation is coming down, right? It's still between that, it's very much within that band, 4 to 6, 2 to 4, 4 plus 2 minus 2 is very good for us. We are well within that band, and for us, we are not going to have that much of a problem in terms of inflation. Right. So all things are working for us, right? All things are working for us. So why should our yields be at this particular level, right? Today we are having a 30-year paper somewhere around 7.12, 7.15. So why is it that knowing such facts where there is going to be a good amount of participation, things are going to improve from here on? Why is it that there is no participation coming in on the debt side? Right. Now, let me take a poll. Are you expecting a rate cut? Second, you can also put in your view before we go into yes or no. You can also add in your view about what you think of debt. Debt as an idea, what you think. You can just put that also if you don't mind. Okay, there's already a question. Debt defaults can happen again, right? Because what we hear is a lot of cleaning up has happened in the last few years. Still some skeleton in the closet. How safe and secure are we in debt? Also, most experts say it's always better to be in shorter term cycle like liquid short-term funds, etc., rather than longer duration. So which cycle of duration is better? Even for long-term holding, of course, it's only past. It's part of asset allocation. Okay, I think the second part is covered into the webinar. The first one I can take it at the end of the webinar. But you can take this poll. Are we expecting a rate cut? Yes or no? We have only one no. Waiting for more people to participate in this. We saw only one no. Okay. Yes, once the US Fed does RBI by falsehood, not necessary. We are in a place where every country is doing its own thing. China is doing its own thing. Russia is doing its own thing. Japan is doing its own thing. They don't care about what the US Fed is doing anymore. They care about their own country now. So it's not necessary. Very honest, no idea. There won't be a rate cut up until September, which means you expect that there will be a rate cut. Okay. Okay. So a lot of you have said yes. Right? So yes, the expectation is that there would be a rate cut. And the reason why I said, you put your view is so that we can have a more fruitful discussion on why do you think it's a yes? Why do you think it's a no? Right. Surely no this year till December 24. Yeah, the expectation is I agree with somebody who said here saying yes, I think in September. I also think yes, in September. There can be September October, November, somewhere between that particular quarter, we might see a particular rate cut. Right? At least to keep the market happy, they would do something. Right? Yes, but we foresee slow moderation rate. It will be a shallow cycle. Yeah, there might be slow sort of rate cuts because things are really bad outside. If you have to travel outside, you travel and see things in the US are very bad, things in Europe are very bad. It's quite expensive now. Things are very, very expensive. Inflation is very high, so I don't know how they are able to manage that sort of household inflation that's there. So if you look at India, if you go through your own expenses that are continuously growing, household inflation usually grows somewhere around 12 to 14%. That's what usually. So when you go and see your spending pattern, you see how things have sort of grown, then you would understand how difficult it is for them outside. So yeah, they might not cut extremely fast, but they every time they come out and they give you a fine print, you would say that yes, 2 years from now they would sort of come off. And so let's see what happens on that part. There won't be a rate cut till September. Yes, I agree. Fed will follow the 10-year market-driven yield fall. Yields are rising right now. So also in addition, now debt taxation is as per individual tax slab. Yes, no indexation benefit. Yes, that's why I did a webinar on arbitrage to say that yes, if you're bothered more about tax, and if you want something on the short-term side where you can still make liquid type returns, then yes, arbitrage works for you. Not until government won't need dividends from its own banks. They still will take dividends. Dividends are part of what comes to the government, but it's not related here. Maybe between 25 to 50 bips by December. Yes, I agree. Quality gone low to keep up with inflation. US might not be compromising on quality. No, US debt is very, very high. It's at an all-time high now. They owe a lot, and whenever they print money, it's like giving debt only to people. So they would go through a lot of problem. That's why US banking system is also going through a lot of problem. Mortgage rates are very high there, right? So a lot of people are not able to save money because they have so many liabilities that they have to pay off, right? And that's why it's hurting them. It's hurting their balance sheets. Right? It's hurting household balance sheets also, right? So majority of you said yes, you're expecting a rate cut. So let's move forward. Y is also done. Now let's look at US rates. Now you look at what is implied, right? There's the hike to cuts. Yes, they are expecting cuts to come in so drastically. That's what is being priced in. And every time something that doesn't work and Powell comes and says a couple of comments, all of this is mutual fund data alone. I've taken all data from public sources only. So nothing is something that I've calculated. All public. So every time he comes and tells something, and it's not something what the market wants to hear, yields shoot up. Right, and that's what's been happening. Yields have been shooting up continuously, and somebody who's able to take an advantage of a 5-year or 7-year paper in the US, definitely there's a good opportunity to take advantage of. Right, but if you look at the US, it is the steepest rate hike in such a short period of time. Right, rates are going up continuously. But what I want you to see is that why things are extremely volatile there is because there the expectation is that things would happen very quick. And one of the comments was that yes, it will be a slow, shallow cycle. Yes, I do also think, and I agree with the participants saying yes, yeah, it might be slow. It might not be as fast as what the market is expecting. So whenever you are in a scenario where the market expects something and it doesn't happen that way, there is a scenario where you can take advantage of. Right. Here for us in India, things are looking good. At least there, things are looking very bad. So that scenario is at least warranted for. Here, things are looking very good. Right? We are not having that much of high inflation. We are not having that bad of an interest rate hike cycle. Our structural policy, structurally, things are looking extremely good, right? And money is expected to come into India. So this scenario that we are currently in terms of our rates being somewhere north of 7% is not warranted for, right? So this means that yes, there is some advantage that you can take it take off right now because of this scenario that's there. And how does this advantage really play out for you if you actually go out and start taking it, right? There was a comment on short term and long term, right? So this is that part where yes, there was a period of time where shorter term yields were much more higher than the longer term yields. It's slightly dated data, but there was a period where we were able to take advantage of the shorter term side, right? And now things are sort of filled in the shorter term side, where now you are having more opportunity to take advantage of on the longer term side, right? So whenever you're shorter term, you're having inverse yield, right? Your shorter is trading more than the longer, then yes, you can take advantage of shorter. Now longer is trading somewhere more than the shorter side, so yes, you should take advantage more when this scenario arises for short to long. Then yes, short, long to short, definitely you can take a longer term advantage, right? So definitely there is a gap to fill, and that's where this opportunity is there for investors to take advantage of. Now, looking at longer duration funds, now let's look at this potential for high returns in a declining rate scenario, right? This slide is important, right? Why? Because let's say we started from a point of 7.2%, and let's say some of you said there's a 50 basis cut, right? On a 50 basis cut, you're still able to make somewhere around on a 3-year basis of 8.2%, which is very good for you, right? So where you start off from, and a lot of money starts flowing in, and then your debts yield start, the government yield starts to go down because there's a lot more money coming in. Naturally, you're going to make a lot more, right? And this is not something I calculated. This is straight from the mutual fund presentation itself. So any scenario that is going to work for you, that where you're expecting a 50 basis point cut, there you're still able to make north of 8%, which is good for a debt product on a longer term side, right? So anybody wanting to take that particular debt product, where you're okay, to sort of wait it through, where you're extremely confident, where a conviction is high, where yes, this scenario says where this requires you to have high conviction, right? At that point, 3 years, you still make very good returns on the debt side. However, on the flip, when things change, which I don't think is happening right now, where if things change towards the other side, then yes, you are going to be on the negative side, right? But this is not a scenario where things are going to look majorly on that side. Probability is obviously there, but it's not very high. But the probability of a rate cut is quite high. Right, and that scenario of how much ever the rate cut can be, this is just a basic calculation. This has nothing to do with market dynamics. It's a basic calculation, right? As market dynamics change, this number also can change slightly on the higher side, slightly more on the higher side. You'll have 8.7, 8.5, something like that, right? But whenever this scenario comes for you, where you should be able to take advantage of, this is that number you should have in mind. That yes, if I start at this starting rate today, the 30-year yields are somewhere around 7.1, 7.3, 7.13, something like that. Right. Today, if I start from here, my expectation should be yes, at this current rate, I should be able to make somewhere north of 8%. Now, all this is without tax. This is just their calculation of how things will look like if a rate change scenario actually takes place. Right. So you're better off here when you want to take a debt call, and this is the expectation that you should have when you're looking to do debt and on the longer term side right now. Today, your shorter term side is somewhere around 7.2%, something, right? Right. And your arbitrage is also slightly on the lower side, which means that your shorter term is very much covered by the entire market. A lot of people have actually taken advantage of. Now, the only place where you can take advantage of is somewhere on the 5 to 7 or the 7+ year sort of horizon, right? Right. In that sort of a scenario, from a longer term perspective, at 7 plus, 10 plus, 30-year, this is that number that you should have in mind. That yes, I want to take advantage of this particular scenario. This is not money that I need. I want to look somewhere from an FD replacement point of view, from a longer term perspective, and this is what I can take advantage of, right? So this is that number that you should have in mind when you're looking to take advantage of, given that yes, there might be a rate cut, and this is the quantity of cut that they're going to take. Right. As things get better, as there are more cuts that take place, this number would start going up, which will work for you in your favor after 3 years. Right. This is just today's scenario, right? As scenarios keep changing, this number would get better. Right. Now, falling rates are good. Yes, that's the duration advantage. M2M game. Longer duration fund benefit from rate cuts. Yes. Anytime where things start to look good, yes, normalization start taking place on the longer term side, but they are more sensitive to interest rates, right? They are very sensitive because you're taking a longer term call. The risk is on the longer term side is slightly higher. Like equity, when you are taking a longer term call, you don't know what's going to happen. Things can do extremely volatile. But if on equity, if you start from a point where valuations are very high, then your next 3 year returns are compromised, right? Because what had to happen in that particular year, or what's supposed to happen in a 5 year cycle, it all gets pushed on to this 1 2 years where all the returns come in the first 2 years. Then naturally the next 3 years would get compromised when you start from a high point. When you start from a low point, you've seen what equity does for you. Right. Likewise, on the debt side, when you're starting at a point where things are looking very good and things are in your favor, naturally you will make high return. Right. But if you're not, then it will work somewhat against you. Right. So the sensitivity towards interest rates for a longer duration call, because you're stuck in for so long, because the paper duration is for so long, right? There it would be more sensitive to interest rates. Right. So this is what you need to think of, that falling rates are good. Yes, they benefit from a rate cut. However, they're very sensitive to interest rates. However, they're very, very sensitive to interest rate because it's a longer term call, right? Whenever you're taking a longer term duration call, there's a lot of uncertainty, there's a lot of volatility that takes place. So naturally, things would be more sensitive. Things would be slightly more on the risky side. Right. Now, let's look at those expectations of a rate cut. We are having a stable rupee. Let's look at that checklist. Yes, stable rupee for us. We are having very high foreign reserves, which is very good for us. Macro good, everything good. Yes. So CPI is less than 6%. Yes, it's well within that band. And whether there is a cut or not, right? So this scenario of that checklist now is that still they're waiting. Fed is still waiting. Fed is still looking out for signs where yes, whether they should cut or not. But inflation is very high there, right? FAI flows are coming in. Foreign reserves are again very, very high. So that is what has actually saved us from very high rupee depreciation. If you look at all the other currencies, US has strengthened against all the currencies that have actually depreciated, right? So that entire pact of developed nations with their currencies, they have actually weakened. India's currency has actually appreciated to all the other currencies very strongly for a good amount of time, except the dollar, right? But our depreciation against the dollar also was not as high compared to history. So that is only because our foreign reserves have been very high, and that actually saved us. So the RBI has done a tremendous job to save us and save the rupee and bring us to where we are today, where a lot of foreign money is expected to come in because of RBI's work. So you must credit them for making sure that we are in a very good place, right? If you just Google saying yes, India pound indices, and you would get everything like this. Right? This is exactly what you might get. It's supposed to bring us $20-25 billion worth of inflows. And why it's important is because as flows start coming in, our bond markets will get deeper, which means that there will be more money to borrow. And as money starts becoming easily available, yields will start going down, right? So it reduces the borrowing cost for corporates also. Second, it deepens the bond market, which means a lot more liquidity is possible. If you remember, there was a credit issue, right? Franklin had a credit issue. That's because our bond markets were not very liquid. It is not very deep. Right? It's not like equity, right? Equity is trading in, trading out. There's a lot of liquidity on the exchanges, but debt is not like that. Debt is a dealer-driven market, which means that if I have the paper, somebody on the other side has to be there to buy it, right? Mutual funds do a very good job because they take over all the execution. They take over that risk. They are the ones creating that sort of liquidity. But a majority of participation where liquidity is high happens only on the government papers. Now, wherever there are corporate AAA or your short or your credit, right, there things are not very deep, right? So as more money starts coming in, as flow starts coming in, there'll be a lot more participation. There'll be a lot more deepening of our bond markets. So a lot of papers would be able to be trading very freely. They can be traded very freely, right? Which is good. Second, it reduces borrowing cost, right? And it reduces borrowing cost. It's good for our corporates, so they can actually start coming to debt markets to raise capital, which in turn can lead to funding for expansion, which is what our country sort of needs now. Now we are going into an expansion phase, and this is why it's very important for more money to start coming. Right, it deepens the bond market, more liquidity available, more people can participate. It reduces borrowing cost, which can again lead to them using this capital to fund for capacity addition. Right. And again, you have GDP growth starting to grow because a lot of capacity starts coming into play. Our money, our pockets start getting much better. We start consuming more. So you know that entire cycle of how things would work if the money starts flowing in here. Right. So I think now I can open the floor for questions. We have a good 15-20 minutes to take on questions. So whatever questions you have, you can put it down, and then I'll do my best to answer it. So I'll go from the beginning. Yeah, debt defaults can happen. We had a period where debt defaults were happening, and that is behavior. It has nothing to do with rates. But yes, debt defaults can happen. Defaults can happen anywhere. A company can go bust, right? It can go from, so likewise, at least on the equity side, you get an exit. You can just exit at a loss. But for a bond, for debt, somebody has to be there. For a mutual fund that is debt oriented, unless and until nobody saw this credit issue sort of happening, we had actively stayed away from credit in 2018. And we looked at credit only after the Franklin issue happened, because at that point of time, fear was there. Likewise, whenever the fear comes in, or whenever this asset category is shunned off, it's very good. Because when people, so rates go up when people start selling off their papers. Right? When people start buying their papers, yields start to go down. Right? That's how debt markets work. It's inverse. Now, during the IL&FS crisis, when that default happened, you were getting AAA, which is the creamiest layer. AAA is very good, high quality. You were getting extremely high quality papers of very strong businesses, houses that were very strong at somewhere around 9.5%. You should not leave that out at that point of time. So whenever there is a scenario where the asset class is shunned off or the category is shunned off, that is when you can take advantage of, because there's a lot of fear, right? There's a lot of fear, and when your participation rate starts going up during the fear point, is when you actually make more than what your or what the market expects you to make, right? So whenever you get this scenario of defaults, and you've been in the market for a long period of time, you know what to take advantage of. So we were able to take advantage of AAA during IL&FS crisis, right? So whenever there's a crisis, that's how you should view the market. Don't think that yes, just because the crisis is happening, I need to be safe, I need to stop. Where you need to take that risk, you need to be, your approach towards taking risk needs to change. That's how you should look at defaults. Shorter term already covered, but which cycle is better? See, it depends on the inversion of the yield. So now we had a scenario last year where could have taken that advantage for shorter term. Now scenarios come for longer term, so just take a longer term call. But now most days equity returns are over, with hardly any focus on interest rate, debt, fixed income, or gold. Too much euphoria. Is it financially healthy? You don't know if it's financially healthy or not. All you need to know is that, okay, if things are like that outside, what do I need to do? I think as per you should take a more conservative call for yourself. So if you want to know how conservative you need to be, where is it that we can be conservative for you, just get in touch with us. I think you're already there on the platform, so we can keep the dialogue continuously going, how we need to be conservative for you. How can I invest in debt? What is the best mode/platform? Mutual funds are the best way for you to go out and start doing debt investing. That's the best way. Don't try to pick up a bond. Don't try to do all of that unless and until you have the capacity to hold it for perp. Right? Perp means perpetual. Unless you want to hold it for the duration of the bond, please go and do that. If you want to trade in and trade out for a bond that's bad behavior. Don't try to do that. Don't think that somebody else on the market will be able to take that paper for you. Don't try to do that. Mutual funds are the best way for you. They'll take over all the execution risk. You don't need to take that execution risk. Mutual funds are the best way for you. What category of debt has an advantage when the interest rate cut starts? It would be long. That's why it would be more on the longer term side. And right now, you can take that advantage on the longer duration side. Short-term rates are kept high due to liquidity tightening by Fed. Do you expect this scenario to continue? No. They have been trying to ease liquidity, but they are not able to. It's bouncing back. Right? So they want to keep that scenario more liquid. So tightening they don't want. They're giving up, but it's not very well accepted itself by the market. If you read 2-3 days back also, they had some sort of liquidity that it's not. They are not able to. It's not going successful. Message is that debt should be taken advantage of. What part of debt should be taken advantage of? It should be more on the longer term side. If you want to know how does debt fit within your asset allocation, whether it should, how much of it works for you, just get in touch with us. Just send us a hi, and somebody from the team will get in touch with you to know how debt can suit you best. Crude is less than $65 and the dollar index is about 90. What happens to bond price and equity markets from here? Usually right, today's scenario is such that crude is not coming off to $65. Face reality. We might not get a scenario where oil consumption starts to go down. Oil consumption starts to go down. That means there is one part of expansion that has not taken place well, or infrastructure is not booming very much. Oil has to remain at these levels because it's difficult. It's continuously getting difficult, right? There was a scenario where dollar was at 90 and equity started to go up. Right? Whenever a currency is weakening, they would look for alternates. Alternates means precious metals. So commodities. So that's why crude can't remain there, right? Whenever you're having a currency or fiat currency that is not as strong as what it's supposed to be, which in this scenario it has been weakening for decades together now. Commodities usually go through a rebasement of price, right? Not reprice, rebase, right? Rebase is completely different from reprice. Rebase means there's a new floor itself for valuing that particular commodity, right? So in that particular market, you should take advantage of precious metals. We have been taking advantage of precious metals on Milestones2Wealth. Anybody who's on the platform would know that, yes, how we are trying to take advantage of precious metals and how it fits your particular asset class based on your particular goals. So if you want to know that, just send us a hi here. But usually in this case, where a currency weakens, at that point, people look for alternate currencies, and that currency happens to be all the precious metals. To go long on debt mutual funds, should I buy in mutual funds? To know if it's going to fit your risk profile, just send us a hi, and we'll be able to tell you whether based on your risk profile, based on your asset allocation, and based on your goals, whether this will work for you or not. Franklin Templeton crisis. Credit. See, credit is basically the fund will lend to low quality borrowers, and when you lend to low quality borrowers, it's not very liquid. Means that I'm holding the paper until maturity. If their scenario changes, I have to go and dump it. Somebody has to be on that side to buy. Right, that's one case. Second, if the fund is having redemption pressure, which means that a lot of investors in the fund say, I want my money back, they have to go dump it. To meet their obligation, they have to go dump it. Now the scenario became such that a lot of their borrowers, which were low quality, started to go bust, and there was redemption pressure that was happening. When that happened, nobody was there to buy. So how will they fund this entire thing? Should they shut the fund for some time until they could recoup that money? As and when they started recouping that money, they started giving it back to their investors. Can we envisage multiple Fed cuts and implications to Indian markets? See, right now things are not. It's decoupled. We've had currencies that are decoupled. We've had interest rates that are decoupled. So whatever works for that particular country is what people would do. Now we have come to that scenario is that, like for example, Japan raised their interest rates. Right, there was another country in Europe that cut their interest rates. Right, so whatever is suiting that particular country for their particular growth is what they would do. Now, large nations are coming away from treasury. China has sold record treasuries and US debt, US agency debts. It's at a record. Last time we saw this was between 13, 14, and 15. Right. So they have done this year also. So wherever there is low demand for uh, that particular paper, naturally they would only look inward. So now all the currencies are starting to look inward. What suits them is what they'll do. So right now for us in India, expectation is that yes, our scenario says that there should be some bit of easing that happens. So let's look at what's happening on the Indian side. Is asset allocation most underrated now in high markets at peak where all choose? Yeah, that's why every time we come at a market high and say no, you should look to do asset allocation. Why you should look to do asset allocation? Because you should not stop participating. You have to, whatever incremental money you're putting has to go towards other asset classes to sort of make sure that you're at the right place at the right time. Right. Some periods are such that you need to go overweight on that particular asset class. Now is not a scenario where you should go underweight or overweight on a particular asset class. Yeah, you can have a much more balanced approach, and asset allocation should be practiced in all markets. What the market is doing is not, you can look at it saying, yeah, this is happening in the market, but that doesn't mean I will go there to change what they think. I will do what is suitable for me, and this is my expectation, and I want this. Right? That doesn't mean that you can go there and say, no, you don't do this. Yeah, the market has a brain of its own. So market will do its own thing. But asset allocation should be practiced in all markets. I'm getting a 7.3% return using SBI Senior Citizen. It is better to move to a debt mutual fund. I see the FD is I don't have to withdraw it anytime. So no, you stick to it. This is fine for you. You don't need to, unless and until you have a back, unless and until you have payouts that are not being met. If it's all being met, then there's no problem at all. If at all, sorry, I missed another question. What is the probability of US starting to go to disinflation and deflation? Is there no probability? I don't expect that the inflation level comes down there. Inflation is sticky there, it's high there. Coffee prices have doubled in the last 1 year. Just for example, right? Coffee prices have just doubled. Cocoa prices have just doubled. That if you go and say that they are a very high consumption nation for such things also, right? So inflation is hitting their pockets very, very badly. So probability is very low. Thank you for your patience. Thank you for joining in. If you do have questions, please do get in touch with us. And to know about how we are able to take advantage of debt, how we can take advantage for you on the debt side, whether it works for you, and how much should it be as a part of your asset allocation, just send us a hi here, and somebody from the team will definitely get in touch with you and put you on that program. Get onto the program. There are a lot more events that will take place. There are a lot more topics that we will cover, and it will be good for you if you're on the program. Yeah, you will get a lot of knowledge, but we will definitely make sure that this knowledge is being put into action. Unless and until it gets put into action, then there's no point of it being as knowledge. Right. So that's what we will do for you. So thank you for being a very good audience for joining in. I'll start taking the next question. If at all we can expect a 2008 like scenario repeat even as 2020 COVID times, markets recover very fast soon, unlike 2008, because otherwise everyone is going gaga gango as if no fall. See, these are black swan events. Don't go based on black swan events. Black swan events teaches you a lot of things, and what you should learn from out of this is that there are a lot of new investors that have come into the market having high expectations. When a market like this, when people start thinking like this, and you know what the participation level is, the maturity of the participation level, the maturity of the participants is very low, right? So you should expect that there is a lot of madness that can take place. What you have to do in that madness, be in a place where there's no madness at all, right? Always try to be contrarian, and that's what we are trying to do in Milestones2Wealth, right? Contrarian, right? So just look through that. Thank you. Great forum to discuss with knowledgeable professor. Thank you. Get onto the platform. Unless and until you get onto the platform, this is not going to be helpful for you at all, because we will do a lot more. And uh, our endeavor is that, yes, to help you create a very strong savings habit, and in turn, it will help you create a lot of in turn, it will help you create a very strong investing habit also. That's what our current endeavor is. So get onto the platform. Just send us a hi, and somebody from the team will definitely get in touch with you. Is it possible to share the PPT deck? Recorded session will come immediately on YouTube, so you can go through all our recorded sessions also if you want to. And there are various topics. So just follow us on social media, and you will get, notification. Just I'm sounding like a uh, influencer. Press the bell icon. You will get in notifications. So you'll also get WhatsApp messages from our side, but uh, just get onto the platform. You can get better everyday returns in small finance banks. Uh, See, if you're getting a better everyday returns, you should take advantage. Wherever you're don't in debt, right? Unless and until there's a very big opportunity for you, don't take advantage of high rates for the sake of high rates, because debt is so tricky that if you get the paper, you're stuck, and if you're stuck, then somebody has to be there on the other side to take it. Then you're definitely stuck. So in debt, have moderate expectations for debt. Don't try to look towards high returns on the debt side. Right? Debt is meant to be consistent. Debt is meant to be stable. Debt is meant to be safe. Right. So even in that safety is where we are trying to look at, is there any risk here also? Risk is going to be in all asset classes, no matter whether it is FD, whatever it is, there will still be some bit of risk that is there. But on debt side, right, look at that as, yes, I want consistency, I want stability, and have very moderate expectations. Don't have equity type expectations here. Right. So when you are getting, debt is supposed to give you somewhere between 7.5 to 8%. Anything in this area is very good. So anything more, that's when risk starts to go up. Right. So you will have debt AIFs that is giving you 12%, 13%. So you imagine the risk that they are taking to give you equity sort of return on debt, which means the risk is extremely higher than equity also. Right. Equity itself, when you're able to make somewhere between 12 and 15% over an extremely long period of time, actually your expectation should be 9 and 12. You're not very much compensated for the risk that you're taking. Right. From a debt perspective, only look at stability, consistency, and set your expectations very moderate. Don't try to get higher on the debt side. That asset class is supposed to be consistent and stable. Value versus growth, because value and recovery making good progress off late. Let me flip. Indian investor mentality says that they would always look for a discount. If you go shopping, when you buy a shirt, you know what the worth of that shirt is. You will say, I don't want, I want to buy only when there's a discount. Right. So by that logic, every investor or every saver in India is a value saver only and a value investor. Right? You go to Swiggy and you get 10% discount, you're going to order. You go to Zepto, they'll give you 5 rupees, 6 rupees off. You'll go, you feel happy and take it. Right? By that logic, every investor is a value investor. Right. So don't say value growth, but everybody has the mentality. Everybody wants to have that sort of growth by having that sort of cautiousness in terms of what they want to pay. Right? So don't categorize something as value or growth. Yes, you are an investor and you are a conscious investor. You are a cautious investor also. So categorize something like that. What is the difference between money market and liquid funds? So money market is part of a liquid fund. So in liquid funds, you will have many categories, which is money market, overnight, ultra short term. So it's just a duration, right? Some will be 1 day, overnight is all 1 day. Ultra short will be somewhere between 30 days or so. And shorter term would be somewhere 3 years and all. It's just the duration, is just a category. But they are all liquid only in nature. Right? It's just duration. How are valuations overall with PE and EPS, as I hear more stretched and might get run out of steam in the next 2 years? That I had covered in the equity presentation, but for the sake of the question, on a broader market side, uh, earnings growth has not been compared to re-rating, that is valuation growth. Earnings growth has not been. It's not justified. Right. There are parts of the market where earnings growth has been strong and valuation growth has not come in, which is good for investors to take advantage of. So if you want to know on the equity side where you should be able to take advantage of, I think you can just go to the YouTube live video section and you'll get to know where we are trying to take advantage of on equity. How is a bond ETF different from buying the same debt mutual fund? See, when you're looking at ETFs, it will follow the price of the particular benchmark one. Now, from experience that we have faced on ETFs, right? ETFs also don't happen to be very, very liquid, right? Pricing there is also slightly, it's not very deep also. Our ETF market is not also, passive market is not very deep also, right? That's why when you're looking towards debt, you need to go towards uh, mutual fund only because of the fact that they manage huge sums of money and they can take advantage, they can take over the execution part. Execution is very, very important for you on the debt side, right? It's not that the ETF won't uh, be able to execute it, but ETFs will follow the benchmark and debt mutual funds will be able to buy a lot of papers. That's the only difference. Right, but always stick here because they manage a huge sums of money. They will be able to take advantage. They will have the muscle to go out and start executing. So always stick there. Can we accept monthly expense from debt like passive income? Will it be advisable for retirement? See, if you want to have both, you want to have some sort of asset allocation that you want to do for retirement planning, just send us a hi here. I put the number, just send us a hi, and we will help you in your retirement planning. Yeah, we can do that, but just send us a hi so we know how much is should be your payout and what is the strategy that we need to do for you and what asset allocation should we follow for you. Just send us a hi. Somebody from the team will get in touch with you. Thank you so much for your time. I think there's 1 more minute, but thank you and kudos to you. I've been seeing you coming in on spending your Saturdays here. I think we do every Saturday mornings are very hectic for the whole team. So thank you for your support. I really appreciate it. So 50 lakhs is only for the PMS. Mutual fund is just distribution, so there's no cap and there's no fee. 50 lakhs is for the PMS. It's SEBI mandate. So if you want to know about the PMS also, just send us a hi. Just send us a hi saying I want to know more about your PMS, and somebody from the team will get in touch with you. Even if you go on our website and you just if you just chat there saying PMS, they're very tech oriented now, so you will get details about our PMS. Thanks. So I think that's about it. No, I don't think that we have more time to sort of take questions. Thank you all for joining in on a Saturday afternoon. Have a great weekend ahead, and do join us for the next week's presentation. Also, you'll get details about it on social media. So do register for it, and let's hope CSK qualifies tonight. Thank you so much.